Hello, and welcome to the Performance Leadership Learning Lab's virtual roundtable titled The Syndicate Advantage, Redefining Value Creation for Small Business Exits. We're glad you're here. A couple items before we get started today. A replay of today's session will be available to all registrants early next week. You will receive a notice via email with a link to our PL3 YouTube page. There you will find today's session and all of our past recordings. Uh, just as we start to look toward the end of the year, we won't be hosting a virtual roundtable in December, but we'll be returning to the roundtable schedule on Thursday, January 15th, 2026, with a topic on technology. So for our guests and attendees that are here today, if you have questions for our panelists, please feel free to drop those questions into the chat at any time. We'll leave time at the end for Q&A. And let's begin with introductions. I'm Will Gladhart, the Chief Marketing Officer at the Culture Think Tank, and I'll be your moderator today. I'd like to ask each of the panelists to share a brief overview of their role and background. Lindsay, we'll start with you, then Bob and Will Lindstrom.
Great. I'm Lindsay Gazowski. I'm the CEO of the Crucible, which is an executive assessment for the leaders of investor-backed companies or those companies that would like to be. And I'm also a member of the Performance Learning Leadership Lab group, like the rest of the people on this call.
Hi, I'm Bob Dunn, Managing Director of GF Data. GF Data, we believe, is the best source of valuation and other financial metrics for private equity-backed companies in the middle market. We track private equity sponsored deals with enterprise values between 10 million and 500 million. All of our data comes directly from private equity contributors. And I'm also a member of PL3.
Great. Will?
Yeah, my name's Will Lindstrom, and I'm the co-founder and CEO of the Culture Think Tank, where we specialize in really helping analyze where organizations and companies can accelerate growth and value, and if they're interested in exit, getting to speed to exit. Part of what we do is collaborate with Bob and Lindsay on the Sage Forge technology, which is specifically designed to help companies grow. And like the others, I'm also a member of the PL3.
Excellent. Well, thanks for those introductions. I'd like to begin with a couple thought-provoking questions. So, Will, we'll begin with you. Kind of highlighting today's topic, what is a syndicate and what is the biggest misconception leaders have about a syndicate versus roll-up?
Yeah, that's a good question. So this concept of a syndicate actually came out of I'm also wrapping up the last of my doctoral program in leadership and learning in organizations with a focus on AI from Vanderbilt. But this concept of a syndicate came about from research of trying to understand why very successful lower middle market companies, $25 million less in enterprise value, all the way down to or revenue, all the way down to less than $1 million in revenue can't sell. And some of that has to do with the leaders themselves. So that's where the leadership research came into play. They're just not ready to it. They don't understand. They're not comfortable. They have a little bit of fear about letting go. All their identities rolled up in the company. But also what came out of that is that they aren't prepared to sell in large part because they're too small. So they're just not big enough to get the multiples. And that's what GF Data specializes in. They give you exactly the breaks to know where you're going to go from a one-time sale of EBITDA up to a 3 to 5, whatever it may be based on your industry. But a lot of these companies are stuck in the one size. And so the concept of a syndicate is, well, what happens if you can collect other like companies in the area? So let's say it's accounting firms or medical practices. And you say, okay, well, there's 6 practices in the area. And what if you can come together, continue to operate separately, but position yourself for sale collectively? Well, what that does is it moves the valuation from maybe, where you're going to only get a 1 times multiple all the way up to 4, 5, 6 times multiple, and allows those owners to extract the value of 30 or 40 years out of their business. And so that's the idea or the concept that came out about a syndicate. Now, the difference between a roll-up and a syndicate is that in a roll-up, you may get to 6 companies if that's the example, but each company is getting bought one at a time. And as a result, they're getting bought at the 1x multiple in our scenario here. So 6 companies, I get bought at 1x, 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 1x. The power of a syndicate is, and so what that's doing is it's putting all the power on the buyer side, right? The buyers are getting them at a discounted rate. And that's also why a lot of these founder leaders aren't selling, because they're like, well, I just rather run it out for the next 2 or 3 years than sell for 1x. However, with the syndicate, what it does is it lets these like leaders go, okay, we're going to continue to operate separately, but we're going to package ourselves collectively. So we're 6 companies. Here we are. We're going to sell as 6 companies. What that does is that allows these leaders now to share in that multiple. So now all of a sudden the leaders are able to share in that multiple. And so instead of selling 1, the 6 are going to sell at one time for 5, 6x. So they're taking, if they're $500,000 multiple or $500,000 EBITDA, then instead of selling for 500,000, now they're able to sell for 2.5 or 3 million, which is life-changing afterwards. The other thing a syndicate does that's really unique is it helps the leaders that are afraid of selling because they don't know what to do afterwards. It helps these very same leaders prepare for that, because now you have other like leaders that are looking to exit. So it creates this peer group. It helps reduce the fear. It helps them learn from each other in preparation for life after their company. So that's really what the syndicate is. And the biggest difference in a syndicate is it's changing the power structure or who has the influence on the sale back towards the sell side. So the sell side can benefit in the accelerated exit opportunity, but it's also preparing them to be able to define what their role is after life. So they can actually have some influence on how they want to transition out, which reduces the fear and helps them sell. So that's really the difference between a syndicate and a roll-up. A roll-up, it's one company, I sell, I get the lowest multiple, and there's no real opportunity for that owner to have influence on how they want to be positioned or how they want to contribute post-sale. So that's the difference between a syndicate and a roll-up.
And Will, also leading up to the sale, you got, the members of the syndicate can largely maintain their autonomy. They haven't been acquired. They're still able to manage their businesses the way it was managing. We can, through AI, bring the books together, and I'm sure we're going to talk about that in a little bit. But I think that's a key component on it too, that you are able to maintain control over that business while still getting it into a larger framework that's going to attract more interest and ultimately go to a higher valuation.
And I think to Will's point about having that peer group to work with, it's really I think an area where people don't give enough consideration to what does it look like once I'm acquired? If you're a small guy that's being acquired as a part of a portfolio, in general, you're just selling your business. And we can talk in a bit about, leadership compatibility and what happens if you want to stay on and some of those components. But a lot of people find themselves selling their business and then saying, well, what now? I'd grown something. That was my identity. This is who I was. I've sold it for less than I was hoping because I'm just a small fry and I don't have any concept of what to do with myself. Do I start something new? Do I stay on and keep working in the business because this is all I know? Having a peer group that you can work with to say, okay, what does this look like and what do I want to do? What are you guys thinking about? How are we thinking through this? What's the right fit for maybe us as a group? That's really important here.
Yeah, I really appreciate that you guys bring that up because I'm going to play golf is not an after work strategy, which sounds great, but after about 6 months, might not be quite as fun. So, Bob, that leads us to the next question. How do valuation multiples change when buyers assess a portfolio instead of a single identity?
Yeah, I mean, it's a great question. I'd actually start a little bit before that question because we're talking about, companies here generally with sub 500 million EBITDA. In that environment, the number that actually make it through to a I mean, we're talking, you get a lower multiple, but the bigger risk on it, I think, is you don't get a deal at all and the business ends up folding, that sort of thing. Or you try and sell as a one-off and you go the business broker route, you're looking at very high fees are going to cut into that one-time multiple on it. So, I mean, scale doesn't just mean increase in valuations, it does, but it's also increased opportunity to actually reach the sale point. In terms of scaling up, though, and I think Will alluded to it quite well, if you're below 1 million in EBITDA, that's really there are a lot of businesses like that out there, and it's not the sort of thing that's going to attract funded capital. And by funded capital, I mean private equity sponsors that have a fund. They need to commit that capital out there. They're not going to do it in dribs and drabs for the most part. They're looking for sizable businesses. So what you find when you get above, the 2, 3, 5 million EBITDA mark, there's a decided uptick up to 4 or 5. And if you get to the upper end of that to, a 7, 8 times multiple, 6 or 7 possibility, just for reaching that scale on it. And again, that's because that represents a reasonable investment for a funded sponsor in the middle market to commit capital to. It's big enough. And the other interesting thing about it is you're essentially creating an investment opportunity for them out of thin air, right? This company, this syndicate, did not exist beforehand. Every private equity firm out there is looking for proprietary deal flow. And if you have essentially there was no company there before, but now there is through the syndicate, that's a great opportunity for them, right? They're finding something that basically didn't exist before. And then I think, as importantly, which Will alluded to, it's really increasing, it's bringing the value back to the business owners on it. Now, generally, if this, would happen, it would be one practitioner in that space that goes out and buys a bunch of other practices, whatever they might be, say, brings them together. They end up with the multiple arbitrage on that. They've built it up on it. It's not spread out among all the original owners. The syndicate actually gives an opportunity to provide that enhanced valuation out to all the members on it and turn what would be potentially no sale, potentially a 1x sale into something that is really sizable on it through the cooperation based on the syndicate.
Great. Any other thoughts, Will and Lindsay?
My only other thought on it is as the multiple moves, it's not only the multiple moves in a syndicate, but there's also, like terms dictate price. So the other thing is it allows the syndicate, those companies in the syndicate to have a greater influence on the terms because they can come together. They can have better influence on the terms. Like if it's a practice management group, I want to sell in 2 years, but I want to continue to work part-time for 3 years. That can kind of be the position. But if you go into that position, those companies that are looking to buy it, that becomes a negotiation lever. Whereas if it's just a strict roll-up, you're kind of at the mercy of who's ever rolling you up because you don't have a market to sell into, and you may not have other interested buyers. But to Bob's point, when you can create these opportunities that out of thin air, or they're kind of the leftovers of previous roll-ups, like they've all been acquired and they're too small, so it's kind of the leftovers. But if you can put these leftovers into a really nice opportunity, you have greater opportunity. So you just have a little bit more control, which gets back to Lindsay's point about life after the company. You can have a little bit better control of it. I like to continue to support it and those types of things. So I think it's the multiple plus the opportunity to have greater influence on terms.
Great. So Lindsay, we'll kind of reflect back to the leadership question about, how does the importance of leadership compatibility between leadership teams differ between a syndicate and a syndicate add-on acquisition versus a platform investment?
Yeah, so in a platform investment with add-ons, what generally happens is the leadership team is determined at that platform level. So you build that leadership team, it often stems from that business of scale that they buy as their initial component, or with a CEO that the fund wants to back and saying, okay, even if it's a smaller company, this is the person that's going to take us forward. And they build around that team. Each add-on that comes in, even if there's talented leadership, they're not usually given the credence that other groups might, because the problem is you already have your leadership team. So frequently we'll see extremely talented, growth-minded CEOs or CROs or even CFOs find themselves in divisional president roles or GM roles or things that really aren't as fulfilling as they would hope because you're just the add-on. And so often that leadership team has to go find something new, which, getting back to the point of what after, really puts it that, to a fine point. Especially if you're looking for a group where they're buying a bunch of companies in a given space and you're not in that top team, they often want you to run for a period of time through that transition. That founder is now running as, sort of a unit leader, so a site manager. And it can be a real blow to people's egos and also not what people thought they were getting out of it, which then keeps your earnout from really materializing because you're not driving it as hard as you would have otherwise. In a syndicate fashion, there's the opportunity to decide, okay, who wants to put their hands up to run something? Who doesn't? Who's thinking about, I did this and I couldn't figure out how to necessarily, given my geography or my capital constraints or whatever else, take this from a business that was 2 million in revenue to, 10 million in revenue, but within the syndicate, I have the skills and talents to do that. Making sure you can put together that team and work well with the rest of management is absolutely critical. And figuring that out amongst the group and figuring out who might have those skills, who's really best suited to be, you've been a founder CEO, but truly your skill set's in sales. You had every, customer relationship, and you should be the go-to-market person for this entity going forward. Or, your background was financial and you happen to have a great idea. Fantastic. Or maybe, and this is often the case in these small companies, no one has a full credit CFO, and that's going to have to be someone brought in. And now you know that you have to plan for that going into this enterprise, as opposed to trying to figure it out after the fact. And so that alignment, that understanding, and that cohesion is really important, and understanding how you work and not just what you want out of the deal, but also how you can work and how you can work together becomes that much more critical. It's one of the fun things about the SageForge tool is that it can highlight what some of these businesses are doing independently, but then also can be used to highlight who does work really well together across things. How do the numbers, come together? Is there an entity within this group? Maybe, we've identified 10 companies that could be a syndicate. Maybe this is really a syndicate of 8 and another 2 that should go collect their own group of people. And so there's a lot of opportunities there for people to find the best fit and the most marketable asset.
I think from an operational side, it also, you get reinforcement of best practices or examples of best practices across, similar businesses, right? Which I think just from that side alone on it, being able to see how the top performer in marketing or the top, performer in terms of sales or that sort of thing, what are they doing differently? It's to a degree a support network as well as an exit mechanism for the participants in it. And, I think there's strength in numbers, there's strength in knowing, who's good at what and being able to emulate that. And this gives you a runway to doing that, as well as a runway to a realization event that may not exist without it.
Yeah, and to touch on that, what I think is really powerful about a syndicate is particularly it's enhancing the ability for people to sell how they want to sell that afterlife thing. So for example, we're starting to work with a set of doctor practices, and there's 3 of them that they sold their practices. They want to continue working 10 or 12 more years. But in the area, there's a bunch of companies or a bunch of other practices. Well, they're looking to exit in 2 or 3 years. Well, this creates the opportunity for them to all come together and say, okay, well, these docs that want to continue to work for a longer runway, well, okay, now we can be a platform. So this is going to be the leadership team that the buyer is going to be investing in. The other companies that are coming in can say, well, I don't want to be around for 10 years. I want to be out in 2 years. Well, okay, knowing that, now all of a sudden we can say, okay, this is how we're going to backfill doctors. This is, we can put a doctor rotating program in. So new docs that are graduating can be in a rotating program. So it allows you to package it together so that everybody that's has the opportunity or is struggling to sell and get the multiples they want can come in, align on those deal terms. And again, back to what Lindsay was saying, the Sage Forge solution is really designed to do two primary things. One is it normalizes all the financials across the company, so you don't have to change your ERPs or your technologies. It's just going to roll through the AI and the interface. It'll create that financial package so that you can present yourself as if you were one group of companies that are all on the same platform technology. But then the other thing does is it gives the insights into how the different leaders work together. So it allows you to align. So now you can actually position yourself and demonstrate the strength of this leadership team, as well as understand the strengths of those leaders that are exiting in 2 to 3 years. So you know how you backfill them. So it creates the opportunity to not only organize in your terms, but also demonstrate the value, which is going to give you additional valuation opportunities on the exit. And as Bob has always been coaching me on, is you get more multiples if you're a platform than if you're an add-on. So it allows companies that maybe only are going to be an add-on, or maybe are going to be able to sell into a roll-up the opportunity and an additional opportunity. So it just creates the flexibility to allow the sell side or the sellers to align and better position themselves for sale and post-sale.
Yeah. So question for everyone, but I think this dovetails off Will Lindstrom's question. What reporting standards or data integrity benchmarks most influence buyer confidence, and how do they impact a syndicate?
So just to touch on that, the biggest issue when it comes to selling is due diligence. It's exhausting on both sides, and it's also a cost and time. It's very timely. So if you're a small company or a large company, the amount of time it takes to do due diligence is not that different. That's the reason why these smaller companies have difficulty to sell. So that's one of the hurdles or the reasons companies struggle to sell. So what we've done with SageForge is we have used our experience to understand what best in practice due diligence looks like from the financials, from the KPIs, from operating metrics. And then, so instead of having to change all the systems, what SageForge does is it integrates. It's a layer that sits on top of everybody else's technologies, whatever you're using, QuickBooks or Mac Practice, doesn't matter. And it pulls in all the data, and then it standardizes it across for every different company. So you can have 6 different companies on 6 different accounting systems, and it's going to standardize it to best in class metrics very quickly, which is streamlines due diligence, but also it allows you to package you can continue to operate separately and then sell collectively, allows you to position yourself within the packet that goes out to the potential buyers as if you were a company all on the same software system. So having to be on the same software system is no longer a limiter, because analytics and AI now allow us to normalize the data. And in the end, the only thing that really matters are the financial metrics. They don't really care too much about the software so long as the financial metrics are all coming out and aligned to how they're either as an add-on, how their other companies report, or how they're used to, or how they report in terms of due diligence.
Interesting.
And it also gives the members of the syndicate a very clear view of how they're progressing and how they're moving on. And I would stress on this, as we have in the past on it, this is not a put the syndicate together today, sell tomorrow, in the same way that it's not, hey, I want to sell my business, put a sign up and start selling it. There's a prep process involved for this, whether it's a syndicate model or a traditional sale model on it. And you generally have, at least a 1 year, 18-month runway, and it could go as long as 3 years on it. So the formation of the syndicate doesn't immediately create the sale. It creates the opportunity for the sale, but SageForge will allow you to see those financials together, ensure that you're moving the right way in terms of revenue growth and keeping the margins strong, which are both extraordinarily important, and that you can have a real path on it with consolidated financials to show off to that prospective buyer on it. But I would stress, the syndicate has the same timeline as an independent sale on it. It's just it's by bringing together, you're going to improve that outcome on it, but it still requires the prep work. And you still need to know the weaknesses of the syndicate and the strengths of the syndicate in the same way you do with a regular company that's acquired.
And
Yeah.
I think that one of the things, the cleaner the numbers and the more easily accessible, the more likely it is for a buyer to want to continue to engage.
Correct.
If there's a problem accessing information, or it could raise questions because they're unsure whether the numbers mean what they say they mean, that's where things start to get dirty and start to fall apart. Is that it's just not worth the effort, given that there are all sorts of other businesses that they could throw money at in similar spaces, usually. And so making sure that there's that opportunity to present well, I think also is a part of this data integrity that enables a better sale, can be a faster sale, but at least a more successful sale process.
And just to touch on what Lindsay was saying, the other thing that's a little bit different than single sales or roll-ups, because in a traditional roll-up, I buy one. Well, that 6 to 9 to 18 months happens in between each individual roll-up. So that's why, so to get to 12 practices, let's say we're using medical practices just as an example here, but to get to 12 practices, well, I've got at least a year long, maybe I can do 2 in a year. So we're looking at 4 to 5, 6 years. The advantage of a syndicate is you can bring all 12 of them together, present them as a package. And so what's enabling to do is that the buyer's only having to do due diligence once, not 12 times. And that's going to, even though the runway is 18 months, maybe, but all 12 can transact in 18 months. So for those companies looking to sell in 2 years, well, the advantage is you can still get to that mark in 2 years. You're just, by bringing all 12 companies together and packaging together a real nice package, you're not only one, you're creating a market for yourself, but two, you're moving the multiple, but three, you're making your due diligence process easier because they only have to technically really do it once. They'll look at, they'll do different auditing techniques, sample auditing, but in the end, they're going to be looking at that packet once. So it does allow, it's a benefit for both sides. That's the nice thing about a syndicate. It actually is advantageous to both sides. You get to sell greater, you're standardized, you create a market for yourself on the sell side. On the buy side, oh my God, here's these companies that haven't, to Bob's point, created out of thin air, but here are these opportunities where I only have to do due diligence once. Well, I'll pay a premium for only having to do due diligence once, and to be able to capture a geographic with one purchase versus having to do it 2 a year for 4 or 5 years.
Excellent. So we've got one final question before we roll into questions for the group, because we have quite a few questions, obviously, on this topic. This is a question for everyone again. What governance or communication frameworks reduce friction in these structures?
I think you can do it in a number of different ways, but open, honest communication is just, I think, a best practice across the board. Understanding how to communicate with one another is also pretty critical in setting some of those ground rules, making sure that you're talking to the same information and having a single source of truth matters. But everyone who's a part of this needs to understand that you're all working to a similar goal. And so there's not an incentive for you to hold back information or to put yourself in a position where you're trying to gamify some part of this to get an advantage over your other syndicate participants. Because if you pull yourself out, you go back to that 1x from the 4x. And so it's not to say that, your business may not be a perfect fit. And if it takes 18 months and all of a sudden you had a huge ramp up, there might be a really good reason to step out. But having that open and honest communication across the board, I think, does help.
Okay. I think that's
I would just agree on that. And I think, again, that's where the standardization of the numbers, where what we're doing is standardizing the calculations. So like, however you report your different chart accounts, they're all reported the same way. So that improves that dialogue, because when you have really clear understandings, then you can actually share best practices. And when you put 12 really smart people together and they can share best practices, it's not rocket science. Everybody levels up, which only helps people make more money. So again, it's that ability to come together, really understand, have visibility to where everybody's numbers are, share best practices, prepare for exit, prepare for post exit, life after exit, but then also level up. And that's really the value of the syndicate. It just benefits everybody.
Okay, excellent. So we'll start off. So first question from our audience is, how do you manage a roll-up that might have one company that is not favorable to an investor?
So that's a really interesting conversation. So, favorable is a big definition, but the most common favorable is, okay, I have, let's say, these advisory firms. Let's say it's accounting firms. I might have one that has EBITDA and revenue of 1.5, EBITDA of 500,000. I might have one that's 200,000. The point being is that oftentimes when you look at it at the syndicate whole, even though the one with 200,000 would be not favorable, would be less favorable, when you put it together into the syndicate, all of a sudden it does have value now because maybe it's a 2, 3 person accounting firm, but they do a very specialized set of offerings. Well, as a part of the syndicate now, well, you can refer that offering to these small companies. So it actually allows you to create a diversified set of services, even if the companies are smaller, that add a tremendous amount of value. And then to Bob's point, you're going to hit these certain points, these certain trigger points where you're at 5 million in EBITDA. That's going to move the multiple. So a lot of it is just getting to the 5 million in EBITDA. And the one thing we always advise, and this is kind of what we help with, is the first step when you're forming a syndicate is what's the thesis around it? What's it look like? Like, okay, we are going to be a group that does this, and then but the value is, and where the GF data becomes so powerful is, okay, we know that there's an appetite for these types of companies at 5 million with this type of service mix, therapy mix, whatever it may be. Well, now we know how to actually organize ourselves and who to recruit into the syndicate so that we actually then create that package that doesn't exist, that the buyers want, and then you're creating that opportunity. So there's really no bad company anymore in a syndicate. They might be too small, but that's okay because they have a service offering. But you want to ground that in or frame that around the thesis. So you don't want to try to go mix machine mechanics with accounting firms because there's no appetite or buyer on the outside. But by understanding and leveraging the GF data insights, you know what that thesis looks like, what that buying thesis looks like. So you're able to actually say, okay, well, we're going to organize ourselves this way. And now you have your buyer group, and then you have clean books, you have clean information, clean due diligence, and now you're going to get that turn. And size doesn't really matter as much. It's more the package becomes more valuable to the buyer.
I'd say size doesn't matter, but performance definitely does,
Yeah,
and
it
you
does.
need thresholds on it. These need to be, they can be small, but they need to be growing. They need to have some amount of margin to them. But again, I think if you start with that construct on it, and it's smaller companies that are growing, that are putting off a good amount of EBITDA proportionally to their size, by putting them together, you're going to figure out if there are ones that are lagging or down, you're going to figure out why they are. You're going to grow the whole by doing that, right? And again, it's sharing the best practices, and I think that it's one of the foundational things, right? You practice, you have a coach, you have that's what you need in this to really level up in terms of for those that are lagging behind the others. And I think the syndicate gives them an opportunity to actually do that because they're seeing it in front of them with these other practices that are doing it. But they do need to be healthy businesses. This is not going to save a distressed business or a group of distressed businesses.
Yeah, this isn't like a mortgage-backed security thing where you're hiding
Yeah.
bad mortgages in with good ones and saying, okay, the average of these will work out, so therefore it's worth this amount. It's all these businesses have to be good businesses at their core. And if there's a business in that potential syndicate that isn't a great business, it's actually bringing down the rest of the business owners too. So I
Yeah.
think pretty quickly it'll be obvious to people. And again, not necessarily day one, because there are opportunities with utilizing the leadership insights, the company insights, all these things to improve everyone's operations as you guys are working together to get toward exit. But there could be scenarios where, someone may lose a major key player or some key customers or something else that makes them not a good fit at this time. And that happens. But that happens through acquisition as well. And the smaller the company is, the more risk there is that that deal is going to fall apart because of one or more issues that invariably comes up as these things materialize.
Yeah, well, Lindsay, I think you covered that. One of our questions that can a company be in a syndicate be bought independently from the syndicate? I mean, you indicated that, it has to be, part of a package, but Will, you nodded your head. So can it be bought independently and pop out?
So that's the value of the syndicate, is that since you're, in a traditional roll up, you're all having to come under one legal entity. And so that gets very expensive, and there's all sorts of issues, and you have to do so. But with the syndicate, what you're doing is you're operating independently as a group of 12, and then you're selling collectively. So that provides flexibility in two ways. One, we're all growing, and I realize that maybe I'm not ready to sell, or I'm not a good fit, whatever it may be. You can remove one member of the syndicate without destroying the syndicate. It's there. The other opportunity too is that as the syndicate is growing and as market conditions may shift, it may be like, well, you know what, there's starting to be stronger demand for this. If we can go from 5 million in EBITDA maybe to $8 million in EBITDA, we can go from 4x to 6x. So it's like, okay, can we go find 3, 4 more companies to add to the syndicate? So it gives you the flexibility on both sides. And if someone gets to the very end and goes, hey, you know what, I'm getting an independent offer, well, they can sell independently. So that's how it all works. So in other words, the transaction, they all operate separately, and then they sell collectively, and they have the flexibility to add, drop, step out, sell independently up until the very end. And then once the letter of intent signed, then they're on the clock, and then they transact at one point in time.
Is a good explanation, Will. Another question: how do you handle marketing for the group of companies that you're trying to sell?
Again, it gets back to that operating separately, because they're going to continue to operate separately, and it's going to depend. If it's practice management groups, they're usually geo-locked, so they're just going to continue to support their geographic areas. If it is, let's say, specialty manufacturing, well, now what happens is now as a syndicate, you can cross-sell the other specialty services and actually grow the whole base. So that's one advantage of a syndicate, is you can start to cross-sell. And the other advantage is from a marketing is, some of these companies are so small that they may not be doing their own marketing, or they have a fractional marketing person. So this is also where, as a syndicate, you can come together and leverage buying power, to have marketing, to get marketing services. And whether they're marketing each one individually, you can bring down the cost. Same holds true with accounting services, all kind of the traditional services that are costs that you can't avoid, that you need. You can get better efficiencies that way.
And if the question is really about, are we functioning as investment bankers? The answer is no, we're a software. We have relationships with various people, but the idea is to help people from that back end to ensure that they do position themselves well. Now, Will, Bob, myself, we all have a lot of relationships in this space and a lot of people that are interested in buying these types of companies. But no, we're not brokers ourselves. Nor do we want to be.
No.
Yeah. I think that's a great clarification of definition, Lindsay. Appreciate that. And then, of course, our final question is an obvious one. What does it cost to do this?
I can touch on that one. So I can touch on it both from our software as well as kind of how syndicates are charging as well. So from our software side, we just are priced as a SaaS. So there's just a monthly fee that you pay for our software, and we provide the leadership insights. We clean up the messy books. We get the packets ready together. So that's just a step. on a software side. So kind of depending upon how the syndicate's structured, what you're doing, there's different packages, but it's priced just as, any kind of a SaaS software would be. We specifically are approaching it to be affordable, so it's not because we're targeting smaller companies. On the other side, when syndicates are formed, the most common deal structures that I'm seeing for the syndicates when they're formed is there is a monthly retainer for the syndicate team, which is usually a value advisor, some type of an integrator, someone with experience to kind of help pull everybody together, someone who's recruiting the other syndicate members to form the syndicate members. So it's usually a team approach. And they are going to charge success fees. Those success fees are significantly lower than a broker fee. And then often the cost of the cost of their services is credited towards the success fee. So in the end, that's the most common structure that I'm seeing. So that's how they're pricing it. So it is and it depends, but more often than not, the cost to get to the sale is credited back against the success fees, and those success fees are typically much lower than broker fees, which can be anywhere from 9 to 15%. And the biggest difference is the brokers aren't trying to move your multiple from 1 to 5. They're just trying to sell you at 1 as quickly as you can. So the syndicate model allows you to not only reduce your fees, but also move your multiples. So you're double dipping or getting more bang for your buck. But if anybody has questions with that, we're happy to share. And if anybody's looking or interested in being a part of a syndicate or looking to form a syndicate, we're happy to introduce you to our network of advisors. That's what they do. They're really good at it and they have relationships. So we're happy to help in that capacity.
Yeah, well, thank you for that, Will. We do have one more question, but it's a complicated one that I think is probably best to refer to Will and Bob and let you guys sort it out. So I will make that connection happen with the final question that we have here. Thank you so much for joining us today. We hope this conversation shed light on the syndicate advantages, redefining value creation for small business exits in order to create stronger outcomes. This roundtable is part of a monthly series from PL3 where we explore topics like leadership, organizational performance, AI, cultural alignment, and investor decision-making in greater depth. As a reminder, we won't be hosting a PL3 roundtable event in December, but we'll return to our monthly roundtable schedule on Thursday, January 15th, 2026, with a topic focusing on technology. To learn more about us, visit pllab.com. We'll see you next time and at the start of the new year.